All right, well, it's noon Eastern. Why don't we get started? Hopefully Chris will be joining us shortly. But welcome everyone. It's Andrew Shapiro from Broadscale Group. I'm gonna turn it over to my friend Bill Squadron from Our Energy Policy. We're delighted to be hosting this session on SPACs and the energy transition with OEP. We've been a frequent collaborator with OEP on sessions. We're used to doing them in person together, usually down at the Yale Club, very nice, but obviously that's not going on right now in these times. But delighted to be working with you again, Bill. And thanks for inviting your network of folks to join in on this discussion. And I look forward to introducing our distinguished guests in a moment.
Thanks, Andrew. And we share your thoughts. We've partnered frequently with Broadscale, and at Our Energy Policy, the ability to host events and our mission of really bringing together people of diverse viewpoints for serious and civil discussion on issues of energy policy, finance, and other critical matters affecting the sector is something that we've shared with Broadscale, and we've worked closely with Andrew for a long time on that. We're delighted to be able to co-host this event today. I'd like to welcome everyone who's joined already and is coming online. Thank you for taking your time to join us. And I'm going to turn it over to Andrew in just a second. The only thing I'd like to mention to the community out there is that we're really grateful for all the support and interest in the webinar series that we put on. We're eager to also do live events again, but in the meantime, we're very pleased to be able to host these kinds of events, and we will have one next week as well, which we hope all of you will be able to join, on energy justice. So with that, I'm sure all of you know Andrew Shapiro needs no introduction. He's one of the nation's leaders on energy innovation, technology, and finance, the founder of Broadscale. So Andrew, I'm going to turn it over to you for what I think will be a fascinating discussion on SPACs and the energy field.
Thank you, Bill. Really delighted to have you here with us and so many folks participating in the session. And I'm really glad to welcome David Crane and Julia Stain here. Christopher Weeks from Cowan, I still think is joining us, but maybe he's having some technical issues getting on. But regardless, we have the two participants who really are going to be the focus of this discussion on SPACs and the energy transition. And let me just quickly introduce them and then we'll get started. So David Crane is the co-founder and CEO of Climate Real Impact Solutions, which is a new special purpose acquisition company that was, I think, just formally launched last month, and he'll tell us more about that. David is very well known in the energy field for his tenure as the CEO of NRG, where he, built the largest independent power production company in the US, and really was a key figure in trying to move the entire energy sector towards cleaner, more efficient solutions, more innovative solutions. He acquired and built businesses in solar, in residential home energy that was cleaner, in carbon capture, in vehicle electrification, and more. And David was really a pioneer in that space. After leaving NRG, he's been involved as an advisor, as a board member, as an investor in clean energy companies. And then, what we're really going to focus on is why this SPAC and why now, and what he aims to do with it. So David, really terrific to have you with us, an old friend and frequent participant in Broadscale's events. And our corporate network is on as well. And many of them have heard from you in the past, so I'm sure we're all glad to see you again, but thanks for being with us.
Thanks for having me, Andrew. It's an honor to be with you and Bill and with Julia. So I'm looking forward to it.
And Julia Stain is also a leader in innovation as it relates more to mobility, but she has been a friend of Broadscale also for a while now. Most recently, she led a micromobility company called Volt. Prior to that, she spent years at General Motors in a number of different corporate leadership roles in corporate development and M&A, and then notably ran General Motors' Maven business, a pioneering car sharing business, which maybe we'll talk about a little bit also during this session. Earlier in her career, she was at Alcoa in corporate development and was an investment banker at Goldman Sachs. And Julia, it's really wonderful to have you with us. You recently joined Vecto IQ over the summer. Really exciting move, as obviously Vecto IQ has quickly gained a reputation as a leader in the SPAC market, led by your colleague, Steve Gursky, who I know you worked with at GM. And so we're really delighted to have you with us as well. And thanks for making the time.
Thank you for having me.
Okay, great. Chris Weeks was going to give a little bit of an overview of the SPAC market. I just heard, is still having some technical issues logging in. So until he gets on, we'll hold off on that. Although I might actually have handy here. I do his latest update. I'm going to just see if I can do a quick screen share on this, because I think the visual will be helpful for folks right here. So this is the Cowan weekly update that they provide to folks in the marketplace. And the key thing here for all of you on the line looking at this is, if you look at year over year SPAC IPO activity, in 2015, the total volume of SPACs was 20 in number, actually went down a bit in 2016. In 17 and 18, we were 34, 46, 59 last year. And this year we've had 143 that are either launched or on file. So, you can just look at this single slide and this single graphic to see how important special purpose acquisition companies have become to the financing of private entities to make them public, to the growth of disruptive technology companies and other growth companies. And so this is the background and the context. And again, Chris will give us a little more when he's able to jump in. But why don't we just start with, I think the key question here is, and I'm going to start with you, David, because as I said, you've been in the clean energy space for years now. What was it about the SPAC structure that you found attractive as a vehicle and as a mechanism to continue to pursue your passion for trying to bring clean energy solutions to mainstream acceptance?
Well, Andrew, I think the short answer to that, well, it's sort of a two-part answer. Number one, what happened with, SPACs have been around for a long time, but this I don't know if you would call it SPAC 3.0 or SPAC 4.0. Let's call it SPAC 2020 era, which was really ushered in with the Nikola SPAC, which was done by Julia's company. What's very interesting about that is two things. Number one is that the fact that Wall Street is basically accepting alternative mobility, moving away from the internal combustion engine, which as we all know, and as a person that comes out of a smokestack industry, the tailpipe problem in the United States, at least, is now significantly greater than the smokestack issues. So the fact that Wall Street is fully embracing a different outcome for the mobility sector is very important. But probably even more important is that this year has seen sort of a historic inversion of between public markets and private equity as to the traditional approach to short-termism and long-termism. Is, I spent 14 years as a public company CEO, and as a public company CEO, you're sort of taught to complain about the quarter-to-quarter fixation of the public markets. But when you look at Nikola or you look at QuantumScape or some of the other SPACs that have been accomplished this year, at least in our sector, the public markets are willing to accept long-term growth prospects, even if there are certain steps that have to be taken to make sure that they're certain. So the long-termism, the embrace of a future growth story, is what makes the public markets very interesting and should be very appealing to the target companies themselves. And on the other side of the ledger, for me, I actually looked very closely at doing a climate SPAC back in 2017. And the companies in the climate space that I was interested in weren't really ready to become public companies at that time. They either their product service offering wasn't either fully developed, or it wasn't at the right price point, or their platform wasn't fully scalable yet, or in a lot of cases the management team was not a management team that was fully ready to be for the public company scrutiny. And over the last 3 or 4 years, I've seen multiple companies that have improved dramatically. And so we see it as much more of a target-rich environment for those of us who are looking to SPAC in the climate space. So that's why I got involved.
Terrific. That's super helpful. Welcome, Chris. I'm glad you finally got in. Sorry if you had technical glitches.
I had a bit, yeah. Thank you, though. Sorry about that.
Let me ask the same question, Julia, of you, and then we'll circle back and get a little more context from Chris. What attracted to you? You've been a banker, a corporate executive, a startup CEO, a board member of big public companies. What attracted you to this type of vehicle?
Well, I think the vehicle itself, and again, as reforming investment banker, is pretty interesting from multiple angles. Where I think is an interesting time in the market right now is there are a bunch of, especially in the mobility space and the EV space and the new technology space, a bunch of companies that have grown up and they've tapped out the private markets. And so again, the valuations and the checks that are being written in the private markets have been done series after series. And so they're really ready to go and become a public company. Where I think is also really important in terms of what the SPAC offers, unlike the traditional IPO, for the companies that show huge growth potential in the construct of what you can disclose as part of the IPO, that really relies very much on the historical projections, that growth story is very challenging to tell. And so it becomes a really interesting and attractive vehicle for the new mobility companies, for the growth companies, for EV, climate change companies to be able to fully explain what the vision is, fully show what the backlog is, because again, the SPAC is not quite the IPO, it's really done in the construct of a merger. So the flexibility of it is very attractive. I think also for the people who are investing in SPAC, and Chris will talk more, that's also a unique vehicle because what they're looking at specific deals, right? They're looking at interesting deals, and the teams are really focused on executing this one transaction. And again, the investors have the flexibility to really be part of something in the future or not. So I think it's an interesting vehicle and the right vehicle for the times and what kind of companies are coming out of the pipeline from the VC stages in the mobility space per se. So what attracted me to this is the ability to really impact a future, to have deals that are interesting to get done, and also think about going forward how this vehicle could be flexible enough for corporates. I've ran corporate development for a lot of large companies, for GM and for Alcoa, very global businesses. And again, there is a lot of structural things that the corporates are tackling internally. How do you kind of realize the valuation multiples of some parts of your business? How do you really think about the shareholder value, the spin outs, et cetera, et cetera. So again, when I look at the SPAC vehicle, I think the future of it could be really, really important for the large corporates as well. And there's a lot of money being raised right now under that umbrella. So I, again, would encourage whoever is in the corporate network to really think how and get to know the specifics of the structure and think how it could be really valuable for all of your corporate needs, guys. It's a really flexible and interesting instrument.
Thank you, Julia and David. Great starting comments. So I'm going to circle back and welcome Christopher Weeks. Christopher is a veteran banker who co-leads the SPAC practice at Cowan, which is one of the most active financial institutions in the SPAC space. Chris, thanks for being with us.
Yeah, thank you, Andrew, and apologies for my technical inabilities to sign in.
So in your absence, what I did, I hope you don't mind, is I actually took the most recent weekly update you sent and I shared that first bar chart, just showing, the annual growth, which might have been a graphic that you would have shared. But give us, your perspective. You've been in this market for a long time now. Why are things, we can take it up a level, even outside of transportation, energy, the areas that we're focused on in this call. Why is this happening now? Does it have something to do with the uncertainty of the market, the pandemic? What's your sense of what's going on?
Sure. And Julia, David, nice to see you again. And glad to be here. Thanks for having me. Maybe I'll just take a step back a little bit and go a bit broader with respect to the evolution of the product. So SPACs have been around for 25 years, right? This is probably SPAC 10 or 11.0 at this point. If you really go back, you really actually have to think about the IPO market and the public markets in general to really understand sort of where we are today. If you go back 2 decades, the public markets consisted of, in the late 90s, 7,500 or so public companies. By 2011, we were less than 3,000 public companies, right? And a big part of that was a number of things: decimalization, market structure changes, Dodd-Frank, Sarbanes-Oxley, bunch of things that basically made it really inefficient to go public, very expensive, and it was an unfriendly place to live, especially for small companies, right? Call it sub $5 billion of market cap. And the Jobs Act in 2012 was sort of the first critical key piece for trying to bring the public markets back. But it was still, at the time, the only way to get public was really through a traditional IPO. And so, fast forward 8 or 9 years to today, and what do we have? We have a number of ways in which small and large companies can access the public markets. One is a traditional IPO, which offers certain benefits and some considerations, right? The second, actually, and I would say prior to this most recent iteration of SPACs, is direct listings. And which is obviously offers some benefits and, again, some considerations with respect to capital raisings, and there are some nuances around that. And then there are SPACs. So we have 3 very healthy ways in which companies can explore going public, raising capital, and or listing on a public exchange such that they can create and have a public currency to use for acquisitions, to use for capital raising going forward, et cetera. There are a couple of specific changes within SPACs, and Julia touched on this a bit, that structural changes that have increased sort of the benefits, I guess, of going public through a SPAC. As Julia mentioned, the use of forward-looking projections is a really critical piece. And I think it's most critical for the topic today too, especially when we're talking about many companies that might be pre-revenue or at least pre-EBITDA and free cash flow. For those companies to be able to actually own their own destiny with respect to telling the story, owning the story, and walking investors through the revenue projections, versus in a traditional IPO where you have to rely on the research analysts to do that for you, and you actually can't publish that in your marketing materials. So the ability to talk about that. The other structural change to the actual security itself was with the vote and the redemption feature, and we don't need to go into it in detail, but in today's version, it is 99% of the time the transactions receive an approval vote. And investors have the ability to either redeem their capital or not. But the technology is improved such that now we raise capital alongside of the SPAC. So it's not just the capital that's in the SPAC that affords companies the ability to raise capital. It's actually through a pipe. And so think of the SPAC now as, it looks very much like an IPO. You raise capital prior to announcing the transaction, similar to many on this call might have looked at it as a Series C or a crossover round just prior to going public, you have the ability to raise capital and de-risk that sort of redemption feature within the SPAC. And so that's afforded companies the ability to really go in with confidence that they can merge with a SPAC and come out on the other side with a yes vote and well capitalized to move the business forward. And the third thing I would say is the quality of the sponsors. We today there were 143 SPAC IPOs this year, about half of the whole IPO market. The quality of the sponsors of the SPACs has improved markedly, right? We have many private equity funds, we have fund managers, investment companies, former CEOs, people like David, and those who will bring real value to the target company versus the previous iteration, which is, well, we used to say 2 guys in a Bloomberg. Now I think we say 2 guys in a WeWork. But the quality of the sponsors have improved such that the value that they can bring, and Julia is on that team, that you can bring to the target universe is that much greater today.
Thanks, Chris. And just let's dig in there for one more minute, and then I'm going to go back to David and Julia. As you look at the broader environment of these 3 options for how companies can get public, a traditional IPO, a direct listing, which a couple big tech companies have done recently, or a SPAC, what was it about the traditional IPO route that you think people were finding unattractive? I could give you my answer, but as someone inside it, I'd like to hear, what you think either the inefficiencies, or was it that lack of ability to talk about future projections and growth and opportunity that was holding those back? And is there any chance, that the traditional IPO process gets reformed in any way by the SEC or others who are, players in that market, such that that balance could shift again? I mean, or do you see SPACs continuing to be, as important a part of the market? As you said, just crossed over 50% of new issuings are being done by a SPAC.
Yeah, I think the metric we want to look at are the mergers, right? The number of mergers with SPACs, and those are called initial business combinations. So you have actual SPAC IPOs where it's just the cash lockbox is going public. Right. I don't really view that as the IPO. I actually view the merger as the IPO. So if you think about, you might have showed my stats on the second page for the M&A piece of it. But if this year, and I'm just looking at it, if this year we've had 143 SPACs that have gone public for $53 billion, with another 74 on file, there have been 31 mergers, initial business combinations, let's call those IPOs, with another that have closed, with another 51 that have been announced, right? And that's for 140 billion dollars of enterprise value. So the balance between new issue of SPAC IPOs and those that are actually affecting mergers is in line and aligned with respect to enterprise value, as well as the new issue capital going out. Look, the IPO market has been challenged for some time, and the main reason has been those structural changes where smaller companies have had a difficult time getting public because decimalization was a big part of it, and that's where effectively the banks can't, the trading piece of IPOs, the banks can't. There's not enough margin there for banks to provide research and to provide the support for small companies that they need as to be a public company in the capital markets. So there's been a structural element that has sort of kept smaller companies from going public. To Julia's point earlier too, the private markets have been open longer. The ability to finance and raise capital in the private markets has created sort of a longer timeline for companies and runway for companies in the private markets. And to Julia's point, those companies are now more mature and ready to go public, but it's just taking longer, so we don't have as many IPOs. And then there's been the push-pull battle between the VC community and the public investors, whether you're Fidelity or or Wellington or the large mutual funds who are perceived as having more control over the IPO market. And we can, talk about Bill Gurley, and that's where the direct listings really started to come out, where we don't want to see this pop on day one because we feel, the VCs and the owners of businesses feel like we are selling stock at too low of a price because the public market investors need such a big discount. So there are, and I guess from an SEC perspective, Jay Clayton has come out and said that this is a very healthy market. Right. He spoke about SPACs a few weeks ago and said, as long as, and look, we are scrutinizing disclosure, but just like we're scrutinizing disclosure over IPO processes and direct listings, as long as there is adequate disclosure for retail investors, smaller investors, as well as institutional investors alike, we're okay having competition in the marketplace for getting public. So that is to say, I think that will there be an evolution of the IPO itself because of SPACs? I don't think so. I think that they would, that the SEC and other regulatory bodies would like to see healthy competition where companies have options. A SPAC is not for every company, like an IPO is not for every company, like a direct listing is not for everybody. They all offer unique functions and sort of unique value add to different types of companies. SPACs, the example there would be the forward-looking projections. And you mentioned, is COVID a piece of why this market has been so robust? I believe so, as it relates to the conversation we're going to have today around energy transition. Again, many of the ESG sustainability related companies are pre-revenue and pre-cash flow, and they have to tell a story and unpack that story. The ability to talk about that is great, and they don't do that in an IPO, so it's healthy competition.
If I may add just one other thing to Chris, and again, from the perspective of the operator for the company that's going through that process, I think another important element, IPO just structurally, it has another two elements that may or may not work. One of that is there is a certain percentage that you usually take public. So the cash proceeds are, predetermined by traditional IPO structures. And then again, you sit there and hope for the best that everybody guessed the pricing range correctly. And you're hoping that, again, you're pricing it and then at the last minute and you're pricing it within the range and it pops and all the jazz that comes with it. I think, again, with a SPAC, what you have is really truly the mechanisms of a merger. So you can pre-negotiate and you can have certainty what sort of capital do you have available and you're putting in the company as you're going forward. And so this ability to really understand the proceeds and how this works and the sizing of it and have the certainty of this execution and the structure, I think, is another important element is for some people, it's crucial as you go through your growth process.
Great, thank you both. We'll come back to some of the other questions related to that. We already have questions coming from the audience. David, let me go to you though. When you think about the kinds of companies that you'd be interested in having Chris combine with, and I know you've said this publicly, so you may want to address this as well, that you're thinking of doing a series of SPACs potentially. Are you thinking about disruptive companies that are new and don't really have much yet in the way of revenue, let alone profit? Or are you thinking there could be mature companies out there that just aren't public yet, but which have more traditional metrics of business success? How are you thinking about it?
Yeah, Andrew, that's a great question. But just one observation on the last discussion about SPAC versus traditional IPO. I listened to it and I feel to a certain degree you're flogging a dead horse, and the dead horse is the traditional IPO. I mean, the companies that we're talking about, by the time we approach them, they're 1 out of 50 is thinking about a traditional IPO. And I'll leave it to you to ask questions, but for most of the companies in our space, the choices are IPO by SPAC, traditional private equity, sell yourself to private equity, or sell yourself to a strategic player, an incumbent that's moving into green. And that question was the choice between those three. Again, I think SPAC is superior, but there are people in your corporate network on the phone that would probably beg to differ. I think that that's a very interesting thing to debate. But to answer your question, we divide the world at our SPAC into sort of what we would call emerging growth companies, classic emerging growth companies, which are, I think, somewhat dismissively being referred to by some investment banks as revenue companies, because they actually have a product and service. And then a group that I call moonshot companies that are, they have something very exciting in late stages of development. They're often pre-revenue, but if they score, they're going to score big. It's not going to be, you're not going to have a 30% upside. You're going to have a 50x upside. It's sort of venture capital thinking. What I think is happening right now, I mean, make no mistake, and this is going to sound sound a little strange from the SPAC person, but the SPAC phenomena right now is a total bubble. This is a Wall Street bubble. Like when Wall Street latches onto something, they do it to excess, and SPACs are being done to excess right now. But the reason that recognizing it's a bubble that we still went forward with the SPAC is that the SPAC structure, for the reasons explained before, is so superior to the other structures out there that we don't think it's going to disappear. But what is going to happen, and I think it's going to happen very shortly, is that there's going to be a flight to quality. And so they're going to be like, good, good SPACs with respected management, true governance in terms of a board of directors that actually reviews the transaction as opposed to rubber stamps it, thorough due diligence on the acquisition, these sort of the whole sort of normal things. And part of that flight to quality, I think, is that what the best SPACs that are going to get into the de-SPACing phase are actually going to be the SPACs that involve, both sides. That you'll see companies put together that have both the classic emerging growth revenue story, plus they have a disruptive technology that's coming in the next couple of years. And so, maybe you combine the technology company with another company that has the ability to deploy that technology. So I think that's where this is going, and certainly that's the type of transaction we would like to do, probably first and foremost.
Thank you. That's great. We've got a lot of questions that have come in. I'm going to try to curate them. Some folks have asked, this feels like 2000 again. Do we think there'll be some day of reckoning for companies that carry more promise than financial results? And is there a risk that it can be pursued in the future as mis-selling the investment if some of these SPACs falter in the public market? What do you all think? Is there any risk that if there are failures out there, or if things don't realize the value they were set at during the initial combination, that the class as a whole will be hurt?
You want to? Well, I mean, let me just start. Yeah, I think they're totally going to be failures out there, and but you see these public investors, by the way, who have just an incredible amount of money right now in their pocket to invest in anything that relates to sustainability. Like if you look at money flows, worldwide in the first quarter of this year when COVID was taking place, there was an outflow of capital from money managers worldwide to the tune of something like, $1 trillion. And in that same quarter, $200 billion went into sustainability funds and impact funds. So there's just a huge amount of money on public markets chasing this. And I think the rationale of some of these fund managers, again, it's a venture capital mindset. Is like, well, if we get 10x on one company and we fail on 3 others, then we still win overall. And I think that mindset works for a while until they start marking down some of those ones that fail to zero. and then, see how much they like that when they get to their year-end review. So I think that, there are going to be failures. One of the good things about, some of the companies, again, led by Nikola and QuantumScape, that are sort of valued on 2027 earnings based on a product that's not coming to the market really until 2023, 2024, is you won't actually know if they're failing for like 3 more years, and so the day of reckoning is off in the future a little bit.
Well, if I may, I think look, SPAC is just a structure, right? It's a way to access the market. It's not a magic valuation wand. It's not like the bottomless pit of cash. So I think it goes the same as for anything else. Like, we shouldn't forget, this is, again, a public instrument for a company to become a public company. And where I see a lot of potential pitfalls is, look, the companies that are going to be traded, they need to be ready to be traded. I think the important part is you're going to have to, as a CEO of this public company, to go out every quarter and tell a story. You're going to have a legitimate milestones. You're having investors that you have responsibility to. And if people are coming to the SPAC investors with a mindset that this is, again, the free pool of money, and then, this is, again, a lot of money being raised, without the really fundamental piece, then they will fail, right? And that's where I think where David is absolutely right. There's a flight to quality. You have to be able to, again, be a credible company out there that's going to act in the best interests of its shareholders. So I don't think there's any more magic than that.
How do we think about geography? Someone that asked, they said seems like a very U.S. thing right now. Maybe Chris, is this happening in Europe and Asia? Are SPACs prominent there?
There are different structures of SPACs in Europe, in Asia. There are SPACs that are being listed in Italy as well. They're very different. They're not technically considered blind pools, and so you can have assets identified prior to raising the SPAC, whereas in the U.S. it is true blind pool. You cannot have, the SPAC sponsor cannot have had discussions around merging a particular company with a SPAC. It's true blind pool. The focus has been on the U.S. today because it is the deepest capital pool in the world, and I think it continues to be. And as David pointed out, we are also collectively, the sponsors, the companies, and Wall Street, very creative with the way that we support the evolution of these products. I do believe, though, we will see more foreign companies trying to access the U.S. capital markets through SPACs, just like other foreign companies try to access the U.S. markets via IPOs. At the end of the day, it really comes down to the appetite of U.S. investors to own and invest in companies that have an international jurisdiction. I think it's going to be a little bit hard for a while we're living in a time where we can't travel as easily and go and sort of touch and feel and have meetings with management in person as easily. And so I think that's a big part of why most of what's happening right now has been in the U.S. And remember, this real wave really did kick off in April of this year. I mean, that is when the sort of SPAC velocity kicked into gear. But again, it's been growing for the last couple of years. I mean, last year we still saw 60 SPAC IPOs. The year before that, 55. So it's been growing slowly, but clearly COVID kind of kicked it into gear.
What do you all see? We have a question here about the role of corporate incumbents. Julia, you referred to this a bit, but like David, maybe I'll ask you, when you were running NRG and trying to launch the green energy component of NRG, if someone had come along and said, hey, let's spin that out and do it as a SPAC, you'll have the capital you need and it'll be kind of a pure play. Would you have considered that? And how do you think corporates, we've got some big strategics on the line here, incumbents from, utility and oil and gas and industry. How should they be thinking about this space?
Yeah, I think this is the best question for this forum to answer, and I'll give you my take on it. First of all, to answer your immediate question, when I came under pressure from our shareholder base at NRG back in 2015, why are you investing in electric vehicle charging? Why are you investing in solar and all that? And, and we came under pressure to sort of either just stop doing that or, sort of move it out. It's amazing that now that this is the first time I've thought about it, all the investment banks came and told us what to do. Not a single one mentioned the idea of a SPAC, and it would have been a great thing. And now, when with your audience, one of my lessons from my own life experience is that radical disruption of a big publicly traded company is difficult to the point of impossible. And you have people on the phone representing companies that were 10 times, 15 times bigger than NRG. And they talk about the valley of death in technology. There's a valley of death in self-disruption as well. And and I'm hoping and praying for the big oil companies that have seen the light and want to make the change, but I'm not putting money on it. And what I would say, what the SPAC offers those companies is a potential lifeline with all the portions of their institution, the people that represent the status quo internally on the board of directors, in the shareholder base. The SPAC allows those folks the idea, well, let's show what this is worth. Let's go out and validate this through a SPAC. We don't have to give up majority control, so we can still consolidate the accounting. We can keep it with whatever name we're calling it by. And if you look right now, I was reading a research report yesterday about AES, and they have a company within AES called Fluence, which would be a great company to SPAC. And there was a research report, I think, from Morgan Stanley yesterday that was stacking up what AES was worth on a sum of parts basis, and they were giving like $3.50 or $4 a share to Fluence. So it's a great thing. It's a phenomenal thing for the big companies to consider doing a carve out through SPAC. And if they do, let me give you my phone number, because we think we would be the perfect person to do it with them. But let me give you one other example, then I promise to shut up. I mean, let's just take a big company that we'll call Tesla for short, and Tesla, maybe we'll call their main business making autos, maybe we'll call them a solar company, whatever. But one thing they have within Tesla is the world's greatest electric vehicle charging network. Tesla could carve out their EV charging network, give it its own capital structure, and it could still be called Tesla Charging. It could still be controlled by Tesla, and it could continue to give Elon control over the entire customer experience, which is, critical to his view on what it means to be a Tesla customer. And so this is an area where you're referring to, where I think you're going to see a lot more SPACs in the future, and it's an area that's acutely of interest to our SPAC.
Well, I'll just add to add to that, Andrew. I think there's not much to add to what David said, but I think where it becomes really uniquely interested for big corporates is when there is a different capex profile, right, that you have to compete within your own organization for capital, which is never easy, different growth trajectories, where the multiples for the comparable companies are incredibly different vis-a-vis some of the historical and the traditional business that, again, the shareholders and the management team and the board are struggling to realize. That's, I think, where the internal conversations would be well placed in terms of, is that the right instrument? And again, I think there is also, given the spectrum of the SPACs out there, you just have to be also careful on the deal side whom you're dealing with on the other side. There are, you know, people like David who's been on the corporate side of the equation, but again, people like us who've been in the, you know, a GM for a long time and understand the dynamics of it. And so again, figuring out how you keep that part of your business in good hands, and again, to just make sure you do the right thing by the shareholders is what you've got to do.
Hey, and Andrew, can I add one more
Sure.
point that, and look, I completely agree with what Julia just said, but there's one other point too for your, you know, your big corporate customers on the phone. I want to tell them that when I talk to a you know, a founder, CEO of one of these emerging growth companies, usually in the clean energy space, and almost always one of the things they'll say to me is, you know, one of the major oil companies has contacted us and would sort of like to buy us, and it's usually a European, you know, oil company, because, you know, they're ahead in terms of collecting assets in this place. My response when they say that to me is, yeah, that's a good company. That's a really good oil and gas company. And they've definitely bought, you know, 4 or 5, you know, companies in this space. Tell me, what did you hear about those 4 or 5 companies once they were bought by the major oil company? And they can never answer the question because, you know, these companies that have been bought by the major European oil companies in our space, they may be doing fantastic things. They may be benefiting tremendously by being within the big corporate embrace of a big European oil company, but no one on the outside can see that. And so the SPAC would give the ability to sort of shine some sunlight on that, which would have the collateral impact of encouraging other companies, you know, entrepreneur-run companies, that maybe they should consider the strategic option, because it doesn't mean full absorption into the giant corporate and never to be heard from again.
Well, and the other issue, which our network has talked about, is acquisitions are hard to do in a big company because you lose talent, right? And so if there is an alternative way to keep the talent in-house and incentivize them, and possibly having a different, you know, corporate entity that's public to do that, could be really interesting.
And, you know, Andrew, that's a really good point, because when I mentioned like 3 years ago, when I would look at these companies, I said, well, your management team's not ready for prime time. I was never talking about the head person, because the head person was always this charismatic entrepreneurial person. But I would always look at the people at the second tier of management and say, none of these people are people that I would have hired at NRG. And what I have seen the last 3 years is the management teams have been dramatically improved at these companies, but now the head person, the founder, is having trouble retaining those people. And the SPAC, it allows you a way to, you know, directly, you know, retain people better and give them reward for their hard work.
Really interesting. Let's talk about a couple of the sectors within energy transition. So, you know, EVs have been kind of the focus area, and I think it's hard to think about a private EV company that probably hasn't been a target of SPACs, and so many have been announced just in the last month or two. I guess 2 questions. Why? Is it just because of Tesla's kind of meteoric rise pulling everybody along? And second, what are the other areas within the energy transition that we think could be next? Is it clean energy? Is it industrial efficiency? Is it food and ag? We've seen 1 or 2 deals there. David, I know you've been passionate about carbon removal. Is that an area that you think, you know, there'll be activity in? And would love to hear from any of you about that.
It's Chris. I can take a crack at it. I mean, EVs, you know, it was really kicked off actually prior to Nikola and Hillian and others with Virgin Galactic. And I'd say outside of EV, it was really the first company that went public through social capital SPAC was Virgin Galactic. That ability to use forward-looking projections, the market very quickly woke up to this, and there was all of a sudden a lot of appetite for that. And so EVs was sort of the next natural kind of wave of companies that came out. But it hasn't just been EVs, it's been around the entire infrastructure, right? We've seen charging, we've seen, with ChargePoint, we've seen battery companies, we've seen assemblers, we've seen actual just the car companies themselves. And there are a number of others that are in the, potentially coming to the market that have a focus on sort of the infrastructure around EV and charging stations. The sustainability, ESG, has been around for a long time. I think the U.S., with respect to investors, we're just catching up to Europe on this. We finally have seen the large long-only mutual funds have a mandate and a requirement to actually invest in the space and invest across subsectors within ESG and sustainability. So the way that I think about it and the way that our research analysts think about it within Cowan, you think about energy and power, resource management, transportation, environmental services, water, ag, advanced materials, maybe a lesser degree, even robotics and IoT. Agriculture is obviously a big one. Environment, controlled environment farming. We've seen a number of transactions in that space. And so I think it's a very wide sort of subsector array of subsectors that I think could be not just good SPAC targets, but that the companies that can get public as well, regular way or through direct listings going forward.
If I may add just on the EVs, I mean, notwithstanding that Tesla has proven nice multiples over time, which doesn't hurt. I think another element when you look at some of the EV companies in the mobility space, it's not like they need to raise money once, right? Because there is one platform coming, then potentially another. So the capital, it keeps moving. So again, at some point you become large enough when you have to be a public company in order to, be able to have access to different pools of capital. And so there's a combination of these things that I think kind of worked in the market and clicked. That sort of makes sense, right? When you step back and think about it as well, from just the practical standpoint.
David, anything else you want to add?
Well, I just very quickly to what I would answer your question if, and trying to just predict the future, which will almost certainly be 100% inaccurate, that, if you ask me which sector is going to surprise for the way that Nicholas surprised at the beginning of 2020 across the hydrogen value chain, I would say, as you allude to, it would be direct air capture. Although, it's hard for me to see that happening in the next few months, but I think that ultimately that becomes a huge area. And then I would say more immediately, Nikola definitely obviously benefited from the Tesla comparison. And the way the public markets have treated the Sunrun Vivint, combination has been, unbelievable. And so, everyone in the residential solar space has to be look at combining so that they can get part of that, because obviously Sunrun Vivint's not going to be the only player in residential solar. And then finally, I'd say the surprise where you don't see a lot of activity is in big renewables. Which,
scale.
Yeah, which, when you talk to banks, they almost never mention a company in that space, which I always think of as sort of being the heart of, clean energy.
Interesting. What's the relationship or the balance between institutional and retail investors driving this, do we think, Chris? I mean, is part of this, again, we're going back to the fact that there's been lockdown, pandemic, there's data that people are appreciating clean air and cities that are less congested. Could this be partly retail driven, or is it all institutional because of, as David said, you've got the Larry Fink letter, you've got all this capital coming into from institutions?
I think it's both. The institutional capital is what are driving the outcomes of the pipes. The first capital to come in, similar to the IPO. The retail component is really post the announcement of the business combination. And it's been prevalent. I mean, we have seen, SPACs be, number 1 through 5 on Robinhood for a long period of time. Since Virgin Galactic went public, it has been, it's interesting. You look at the sort of the size of each trade on average. For many of these companies that are going public, they're very small, like 150 shares at a clip. And so that's not institutional buying and selling. That's, retail investors sitting at home. Most of, us are still sitting at home, despite me being in my office today, with the ability to trade very small, lots of stock back and forth. And so much of the volume that we see in many of these companies is in fact retail. And that's both good and bad, right? I mean, you have the liquidity profile of most of the companies today going public through SPACs have afforded, a more mature liquidity profile, and that's driven by retail. However, sentiment and volatility is also, the volatility is increased because of retail. Social media has played a big part, which I think is a really dangerous game for many companies that are going public, whether you're through an IPO or a direct listing or a SPAC. The ability for all investors, institutional and retail, to see tweets from CEOs, whether you're Elon Musk or others, and actually trade stock on that, that has been a big driving force, both to the upside and to the downside for many of these transactions. And so that is why we have seen the SEC, perk up a little bit and say we need to make sure that there are adequate disclosures for all of these avenues to go public, which I would suggest that for SPACs in particular, since it's part of this conversation, there's an incredible amount of disclosure. There's an S1, there's an S4, there are other documents. There are 2 roadshows, not just one roadshow, like an IPO, one for a PIPE and one for that sort of de-SPAC process where you're going out to the broader public market to generate interest from all investors, including retail. So I think it's a balance. But retail certainly is playing a meaningful portion or part in this in the evolution of this product.
Thanks, Chris. Julie and David, I'm going to close out. We've got just 2 minutes, so maybe you can each take 1 minute to address this question. Are SPACs here to stay, and how important will they be to achieving the energy transition that we're all seeking to a more sustainable outcome? Who wants to go first?
Well, I'll start. I have to say that given the amount of money that's been raised under the SPAC umbrella, I would venture to say they're here to stay for at least the next 2 years to work through all this capital. And I think we'll see how effective it is in the continuation of the growth trajectory in the mobility and energy space. But there's a lot of money out there.
Thank you.
My answer would be, as Chris pointed out, I mean, the SPAC is the creature that never dies, so I don't think there's anything here that's going to happen in this incarnation that's going to kill it. The question really is, is it going to move the needle on solving for climate change? And to me, the answer to that question depends on, I mean, if SPACs were just used as an alternative way to go public for emerging growth companies, like I mentioned before, are you really saving the planet by doing a SPAC of a large renewable company, a company that does, big solar installations? If that company didn't exist, there'd be 10 others that would take its place. But the fact that the SPAC vehicle is being used for these moonshot deals, companies that are really trying to change the equation in something like heavy duty land transport, which is what 5 or 6% of carbon emissions worldwide. If the SPAC is going to be a game changer, if the willingness to continue to fund those companies persist. And so hopefully it will, because we need all the tools in the tool chest to win the fight against climate.
Well, that is an excellent place to leave things off. We still have a lot of questions from folks. We had hundreds of people on this Zoom, so I want to thank everybody who joined us. all the Broadscale Network members, our friends from OEP and their constituents. I want to thank David and Julia and Chris. There were a bunch of questions on here that were more tactical about how SPACs work. I would encourage you guys, Cowan has materials that are publicly available to folks if you want to learn more about, what is a de-SPAC process, what do the fees look like versus traditional IPOs. But I want to thank all three of our panelists. Chris, sorry you had some trouble getting on technically. David and Julia, really a pleasure to have you with us again. And good luck with your initiatives. And thanks for being with us today. And thanks everyone for listening in.
Thank you.
Thank you. Thanks, Andrew.
Take care, everybody. Thank you.